Do you ever wonder if it's a good time to buy a stock? Are you ever curious if you should sell your shares now or wait for them to go higher? I'm going to show you how to value a stock using a discounted cash flow model. Then we are going to analyze the ratios and compare them to its competitors. Watch the whole video and make sure to read the charts and pop-ups in order to gain the most knowledge. Honeywell is a multi-billion-dollar corporation. They're 3M's biggest competitor, and we're going to value their stock in this video. So let's get started with the model. First, we need the market cap because we want to see how much the company is worth. So they're $104.8 billion market cap. That's a value according to the stock market. And the stock price is $149.15. That's what they trade per share. So to figure out the shares outstanding, you take the market cap divided by the stock price, you get the shares outstanding. Now, to figure out the value of a company, of any company, you have to estimate the future free cash flows, and you discount those cash flows back to today's dollars. And let's get their actual free cash flows for the past few years, because that's going to help us a lot to figure out the future. And it looks really good. They have between $4 and $6 billion of cash flow each year. That's cash after operating their businesses minus capital expenditures. So let's see their net income. That's the profit and loss, and that's on the income statement. And that's also looks pretty good. And the revenue is the sales, and that's about 35 to 42 a year billion. So net income looks pretty good. Although you could see in 2017 it was 1.7 billion, then jumped to 6.8 billion. So something happened in 2017, and I don't think it was a cash item, because you see how cash flow increased from 4.4 to 4.9 to 5.6 to 6. So obviously in 2017 it was probably a non-cash item, like they wrote down an intangible asset or something like that. But as long as the numbers are positive and fairly consistent, then we can value the company. So let's figure out that capital structure, because we need to know the discount rate we need to apply to the future cash flows. So their interest expense, that's the interest they pay on their debt, is $357 million. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section, and current debt is $4.9 billion. That's debt due within 12 months. And a long-term debt of $11 billion, that's debt due after 12 months. And since interest payments are tax deductible, let's get their effective tax rate. So the income before tax is $7.6 billion, and the income tax is $1.3 billion. So it's hard to look at the income statement because they use accrual accounting. So, like for instance, in 2017, they had an income of $6.9 billion, but they paid $5.2 billion in taxes. So obviously, they're passing through gains or losses from prior years. So the income statement, you have to combine many, many years to figure out what's going on. That's why it's a hard statement to look at, and you really have to understand how accounting works. Since they pay 2.2% interest on the debt, we reduce it by the taxes, and it only cost them 1.8%, which is a pretty low rate. Let's get their beta, because we want to find out their cost of equity. So the beta is 1.07, so the stock moves pretty much with the market. So that's a good sign. So let's get a little more information from the balance sheet. Let's get their current assets. That's mainly cash, accounts receivable, and inventory. Those are assets that can easily be liquidated into cash. So current assets is $24 billion. $10 billion of that is cash. Let's get their liabilities. Current liabilities is $18 billion. And let's see how much equity they have. That's the value of the company. That's total assets minus total liabilities. So $18.5 billion of equity. Next, we need operating income, or the EBIT, earnings before interest and taxes. That's how much they generate in income from their normal business operations, $6.9 billion. So now that we have the entire capital structure of the company, we can see their debt is 46%. So that's not too bad. It's under 50%, so I think it's manageable. And to get their weighted average cost of capital, it's a combination of cost of equity and cost of debt. And you combine those together and you get 6.5%. So let's look at their future cash flows. So we estimated 4 years of free cash flow. Then we did a terminal value all years past year 4. We discounted those numbers back to today using the weighted average cost of capital we calculated earlier, and we get a value of the company of $82 billion, and we divide that by 703 million shares, and we get an intrinsic stock price of 117. So it's trading at a 27% premium. And so it's a sell according to the model. Let's see where it was. So right when coronavirus hit, it was around 117 mark. Let's see what Simply Wall Street calculates the value of the company. So they're at 151, so they're a little higher than me. So I guess my model is a little more aggressive than theirs. So a stock can always trade higher or lower than the market. When people want to buy a stock, it usually pushes the price higher and higher. When more people want to sell a stock, it pushes the price lower and lower. So people look to a lot of things like financials, which is what we looked at. They also look at external factors like competition and inflation and taxes. And there's also market sentiment, how people feel about companies or feel about the market as a whole. So let's look at their financial ratios. Maybe we get some more information. So they have a PE ratio of 17. I usually look for 15 or lower in a company, but anytime you look at ratios, you want to compare it to its competitors. These numbers on the side, this is the average PE ratio for a company, and this is the median PE ratio. I like median numbers better than averages, because averages, when there's a really big number or a really small number, like if there was a negative 1,000 or a positive 1,000 in your list of numbers, it would really skew the average. But median kind of takes care of that. Price of sales, it's a pretty good price of sales. I like to see under 2.2. They have 2.9, so it's not too bad. So the median company has 1.8. But these numbers are of the entire market, not just this industry. So keep that in mind. The price to book is a little high. They have 5.7. I like to see under 3.3. The average of the entire market is 3.5 and the median is 2.2. So they're a little higher. So they just might have a little bit too much debt on their books. So let's keep going. Current ratio, they're in good shape, 1.3. As long as they're between 1 and 2, it's usually good. That means they have enough liquid assets to cover their current liabilities. ROE, they have a really good ROE. The median ROE is 16%. See, the average is 3% because there's just some companies that have like a negative 1,000 ROE because they reported negative income, and it really skews the numbers. So that's why I like median. The median company is 16%. I look for 20%. So they're in good shape with 33, but of course we need to compare it to their competitors to make sure it's actually good. Interest coverage ratio, how many times can they cover their interest payment? And this is their operating income over the interest expense. So they can cover it 19 times. That's good, because you don't want a company that can only cover their interest once or twice. Debt, they're right at the median. They're 46% debt. So let's compare the competitors. This is the best way to gauge whether the company's doing well or not, because it may look good compared to the entire market, but some industries are just naturally higher or lower in certain ratios. But Honeywell is the best PE, so that's a good sign for Honeywell. 3M is pretty close to them. Price to sales, so Honeywell and 3M are in good shape in that category. That's price of the stock over sales per share. And then price to book, you generally want to see a company with a fairly low price to book, because if you're investing in a company with a high price to book, they're just loaded with liabilities, and you probably wouldn't want that. You want a healthy balance sheet. That's generally what indicates a successful company in the long run. Current ratio, they're all in good shape. They're all Graco is a bit high. They may be sitting on a little too much cash, but better a little high than too low. ROE, all seem to be in good shape for ROE, although 3M is by far in the best shape in that category. They're providing a really good return to their equity holders. Now, 3M uses a lot of debt, so that's what you have to look at. When you see companies with a lot of debt, like 67% debt, may just be the reason why their ratios up here are so much better, because they're taking on debt to improve these ratios. So it's kind of a balancing act. You have to look at all the different things and figure out what works, because you can't, two companies are identical. There's always going to be differences. So you just kind of figure out what those differences are and which one is better or worse. So Graco is really low in debt, but that's not a bad thing if you're using it wisely and you're able to pay off your debt. You have a healthy interest coverage ratio. It's not a terrible thing. I'd say under 50%. Once it goes north of 50%, it could be a little sticky. But so Graco is just a tiny company. 3M and Honeywell are giants. So even though they're in the same industry, comparing Graco isn't as fair as Honeywell and 3M are a better comparison side by side. So I also have my calculation of expected default in the next 12 months. So they're 2%. So I don't think it's likely they're going to default in the next 12 months. So let me know what you think in the comments. It was a fun company to look at. What do you think of Honeywell? I bet you own products that are Honeywell. You didn't even realize it. So thanks for watching.